Okay, so mortgages, if you want to own your own home, which who doesn't? We all do. There's some things that you need to know. Now, Mick Szoka's back with us. Great to have you. Expert from Union Home Mortgage.
Oh, thank you. Good morning.
Yeah, we've talked about a lot of these different things about how you buy a home, how you get a mortgage, you know, and this time it's collateral.
Right, right.
So collateral damage. No, not collateral damage.
No collateral
that was
damage.
The movie.
Yep.
Okay, so what is collateral? Because if you don't have collateral, likely you are not going to get a mortgage.
Exactly. So as a recap, you know, we started off, we talked about income, and we talked about credit, and then we talked about assets, and the last of the four pieces is the collateral.
Because assets and collateral, those are hard.
Well,
you kind of get those mixed up.
Well, yeah, assets are your own cash and your own financial. The collateral is the property. It is the home or the property.
Non-liquid assets.
Right, that is going to be leveraged, so the mortgage is going to be placed against that property for the loan that you're going to be taking out.
Okay, so if for some reason you default on the loan, then this collateral comes into being to protect the mortgage company, to protect this money that they have given to you.
Exactly. So the difference is a mortgage is a secured lien as opposed to an unsecured lien. Credit cards are unsecured. They can't come and grab whatever you bought on a credit.
Your smaller loans, like
Right.
I had an antique vehicle. If you've got good credit, you know, you can get it without
exactly.
a collateral.
Whereas a mortgage is kind of like a car loan, same thing, that is secured. So if you default, right, they can repossess or foreclose in the real estate market.
Yeah, there's some value in the house you're buying, but then you also want other kind of collateral.
Absolutely.
So what other kind of collateral?
Well, really we're looking at the collateral of the house, and how that's determined is by an appraisal, right?
Okay.
So during the mortgage process, we're going to have an appraisal completed by a third party, a disinterested third party that's going to create the appraisal and submit that to us to determine whether the sales price, if you're buying a home or if you're refinancing the home, what the value is.
And how do they determine that? How do they, on the appraisal, what do they look at?
Yeah, so different loan types have different, the appraisal is a little bit different, but the common part is that when an appraisal is completed, they'll compare it to similar type properties that have recently transferred within the close proximity of the property that you're financing. And then they'll make adjustments up and down for the differences in sizes, bedrooms, bathrooms, you know, other amenities, so forth, and so that's how they determine the value, the interpreted value of that particular
And I know
property.
they take a lot of photos, and so you can get a copy of your appraisal if you want, which is fun, unless you don't like the appraisal, which you never know.
You know, and one thing some folks don't know is sometimes an appraisal is not necessary. We have some loan products, depending upon the amount of down payment a person's putting or the loan compared to the value if you're doing a refinance. The automated underwriting systems that are all now in place sometimes will come back in this age of data accumulation. In these automated systems, they'll look at it and say, yeah, that house is probably worth what you're saying it's worth. We don't need to do the appraisal. So we can save people some money.
Yeah, because it's what, $300, $400, $700?
It's
been a while since I had to get one.
Yeah, it's more like $550 to $650, and then maybe higher depending upon the value.
Does the buyer or the seller, if you were buying and selling, who pays for that? Because I know it depends. Usually
initially it's always the buyer, the borrower. Sometimes in contracts there'll be seller concessions where a seller's agreed to cover some of the borrower's costs. At that point, then it can be reimbursed to the buyer.
Okay, and you don't need usually other collateral of your own to make that loan work?
Correct, because everything else will be assets. There won't be any other collateral that will have a lien against it on a mortgage. So like a car or that other collateral, all falls
so you
into
won't
the asset
lien my
bucket.
piano.
Correct.
That would be in like the assets. So you have this many furnishings of value.
Exactly.
Or whatever. Okay.
Exactly.
Well, it's kind of a fascinating thing because, okay, now you talked about down payment. So is there like a line, or it depends on the cost of the house, how much you need for down?
It really depends upon the loan program, and can be also where the house is located. Like USDA loans, 0 down payment, but they have to be out in rural areas. Most of Prescott and Prescott Valley don't qualify. Chino, Dewey, outside, so forth, do qualify. VA loans, 0 down payment. Okay?
Oh, yes.
So wherever they're at.
That's great for
right?
our veterans. Sure.
Fannie Mae has what they call the Home Ready product. Now that's available in some areas. Check with me to find out. That's a 3% down payment.
Wow. Okay, and that's really good. Now, but there's only certain homes that will qualify for that. Like if you like fixer-uppers like I do, because I like, then those usually, it's very hard. It has been. I'll do some personal experience. It's been very hard for us to get FHA loans on these because they're like a wreck.
Right. Yeah.
You know, and people, it's like, no. It's like, I know, but we'll fix it up really neat.
Yeah.
No.
And we have different loan products to do that, to encompass all the dollars you would need to purchase the property and the dollars you
have to put into it to make it work.
And then we base the loan and the appraisal based on if it was as it's completed. So if you bought a house for 150, let's say, and you needed 75 in it, it would be 225. We do the appraisal as if it was done. If it appraised at 225, we could be good to go.
Oh, that's interesting.
Yeah.
So you can get monies to fix it up, which is obviously very important if you don't have a deep pocket.
Well, especially, a lot of people think about, well, maybe I'll use credit cards, this, that, so forth. Why use a high interest rate credit card when mortgage rates are in the 4s or 5s to borrow that for those monies?
You can borrow, you can put your down payment on a credit card?
No, the money's to repair the home.
Oh, to do the home as you're
you're
fixing it up and making it good. I know, well, there's a lot to know. I mean, very few people, even if they have the money, want to do a large down because if you're leveraging your money, you want to have that to use. So, the lower that you can get that, the better. So
there's a balance between that because there's mortgage insurance involved as well. So anytime you put less than 20% down, there's going to be mortgage insurance built into your payment as well.
Which is an extra protection kind of thing?
Yep, for the lenders in case of the default we talked about before.
Right. And so that goes into a little savings account in case?
Somewhat, yeah. It goes to the mortgage insurance companies just like any other type of insurance.
Do you get that back? You don't get that back if you've been really good and made all your payments?
No. So there's so there's a balance, right? So there's a lot of options, a lot of ways to finance.
Love it. And the way to do it is just get in there to Union Home Mortgage. Where are you located?
Yeah, we're 325 West Gurley Street, right in downtown Prescott, Suite 104.
So go on, because you've got options that people just don't know about, because that's what you specialize in, and you can find a loan for almost everybody.
Pretty much.
Awesome. Mick Szoka, Union Home Mortgage, right here in Prescott. Thanks for joining us.
Well, thank you again.
Wow.